just gonna go over like a standard what an options contract is, going over like what the premiums are, how you trade premiums, just very basics options 101 course. So
Yeah, it kind of just talks about what options are, like Troy said. The reading the options flow is actually not that difficult. That'll be probably the last part.
okay.
We're just kind of gonna go through the Greek so you kind of understand um, everything about the options. Because I mean, it sounds simple at times. It is once you get used to it, but um, it's not just like picking a strike and just going with it. You got to make sure you know the Greeks underneath on the underlying, because that can affect how well your options move.
Um, yeah, because they decay and whatnot, all depends on your strike. We'll get into it here. So uh, let's see, how do I move the slide? There we go. All right,
You can just press enter.
there we go.
Okay. All right. So I'm not sure if a lot of people know that options is pretty much just like a contract that you're pretty much buying. It gives you the right to buy or sell a security at a fixed price, all right, by a specified date. So one contract is usually like 100 shares of any equity that you're choosing to play. So a lot of times, if you want to play, let's say, an NVIDIA call, um, when you buy one call, you're paying the premium or the price to play 100 shares of Nvidia, but you're not really buying 100 shares of Nvidia. So that's where the benefit of options comes into play, because you're kind of saving yourself money um, on the fact that you don't have to buy 100 shares of Nvidia. So we'll get into a little bit more later on the risk and benefits of that. But there's two different types of options. We have option buyers and option sellers. Option buyers is what most people do, and what you probably would be doing as a trader or a day trader, where you pretty much pay a premium and you're the holder. So if you're buying a option call, you're buying the right to purchase 100 shares at that price. Um, by the expiration date. Obviously, you don't have to exercise those options. You can sell the option for the profit. But that's the theory or the idea behind it. If you're buying a put, you're buying the right to sell the stock, or 100 shares of that stock at that specific price. Option sellers are usually writers. They write options, and we'll see that in the flow later. These are usually done by investors or big boys who know like where price action is really going to go and you're really confident. I usually don't recommend writing options unless you're really confident and you have the ability or the capital to cover in case it goes against you. Because writing options can go against you and force you to either sell your shares if you have them, or buy shares if the contract goes against you. So just keep that in mind. So when you're buying a contract, you're indirectly trading the underlying asset without purchasing it. Like I said, so like if you have one contract of Nvidia, 1,000 call, you're trading 100 shares of Nvidia without having to actually buy 100 shares of Nvidia. So let's say a premium of Nvidia $1,000 calls is like it's like $2,000. You don't have to pay 110, what is it, 100,000 dollars to get 100 shares of Nvidia. Instead, you're paying $1,000 to play with those 100 shares. So, yeah. So, I mean, is it really that simple? I mean, there's some other things you need to know about it. We'll talk about the Greeks, and that's probably going to be the next couple of slides. So,
Yeah, so essentially, when you buy an options contract, say you buy a call and you buy like $1,000 call for say next Friday, basically, if Nvidia, so what it's basically saying is if Nvidia closes above $1,000 on like next Friday, and you still have that options contract and you didn't sell it, it's giving you the right to buy 100 shares of Nvidia at $1,000, even though the stock is at 1,100. So you're essentially, so if you do have the capital to buy 100 shares of Nvidia, you're automatically up $100 per every share that for those 100 shares that you have. If I,
yeah, and pretty
yeah,
much, yeah. So pretty much if you don't have to exercise that, right? Because I mean,
yep.
a lot of times people don't exercise it, like traders, day traders don't, swing traders don't, but a lot of people who are big money who buy like these deep calls, they tend to exercise it, especially when they buy them deep in the money because any profit that you make on the options, if you exercise the option, you buy those shares and those profits get transferred into those shares. Um, in terms of one of the disadvantages, which will be on later slides, is tax consequences. So obviously, if you exercise the option, it turns into shares. So sometimes big money does that because then once you're holding the shares and you don't sell them, it doesn't count against you as capital gain. So, but if you do sell the option and you take the profit, you're profiting. So it does go against you as capital gain.
Yep. Yeah,
All right.
basically, and then for just to cover like the option seller, like I said, it's not what most people do. You need more money for that. But basically, if you lose on your option, the person who sold it to you is obviously the one that's making the money. So they're hoping that it goes against you. So um,
Yeah.
that's
Yeah,
really
and
that.
we'll see later in like flow talk. That's where you have to be careful what you have to look out for because if you see something and you're like, oh, I really like this option, but if it's not really going towards you, it could be just a big whale writing you a contract to collect premium. I mean, it just means your money is just gonna go down the drain. They're just gonna take the premium from you.
Yep. Yeah.
Unless we
Exactly.
get some macro news that somehow goes against them that they didn't know about.
hmm
So
And basically, the premium that you're paying. So, like, if your call is like or your put is at $2 and the stock goes up, then obviously those calls go up. So, like, you're basically trading the premium. You're buying that $2 premium for every share, but essentially, is that's what you're paying to have the option to buy 100 shares at that price. So that's why a lot of people just are trading the premiums. They're not actually buying the contracts to then convert into shares. They're just simply trading the premium of the options contract. So
correct. So like here we have examples of like, I mean, I just chose NVIDIA because it's just what I was doing recently. So, um, but you can see that I just took some from Robinhood here, so easy to see. You can buy a 1300 call for 621. You can see the ask and the bid. So ask is usually on the bullish side. If someone's buying at an ask side, um, it's like they really want to get in. Bid side is usually someone selling the contracts or closing them out. So you're more likely to fill on a call if it's going in the bullish direction, if it's on the ask side. Um, so we can see there's a lot of different markers on there that we'll talk about later. You have IV, you have the Greeks at the bottom, like delta, gamma, vega, theta, which we'll talk about. And then on the other side, you see the puts. Same thing with the puts. You can see that there's a bid side and ask side. If the ask side is getting pushed on the puts, that means people are buying the puts over the calls. And then you can see there's open interest and then there's volume. So open interest usually is just how many of those contracts are currently open on the day. And then volume is how many were opened on that specific day. So open interest is overall. Now you have to notice that if someone, let's say, bought NVIDIA calls today, that would show up in the volume. And then you want that volume to roll over into the open interest tomorrow if they are still holding those calls. And open interest usually does not update until the next opening day. So that's where you have to be careful when you look at option flows because sometimes you might see that it's a good option to get on. If you're not confident, don't get on it because it could just be a volume. It could just show up as a volume today because they're selling you the contracts, or if they close the contracts before the end of the day, the next day it won't show up in the open interest. So sometimes when I look at really good options, I like to wait a day after they show up on the flow. Um, if it's a swing trade to see if it really sticks, because once it sticks, then I can get in. I'd rather pay a little bit higher premium to get in to make sure that it's consistent going in that direction than to just YOLO in, unless the chart looks really good to me.
I agree. Yeah. So, want to get into uh, just the terminology now, Div.
Yeah, yeah. So yeah, I mean, you can do it if you want, or I can do it. Doesn't matter.
It doesn't matter. Go ahead.
So there's just a terminology. There's a lot written on here. I'm not gonna read it all. I just write it all because if anyone wants to like look at the slides later, I'll post them. You can go through it yourself. But you have different types of terminologies for options. You have the strike price, which is the price that you want to select as your target. That's your goal. The strike price usually is not the in the money price. So sometimes the in the money price is a little bit higher than the strike price. Then you have the expiration date. Obviously, it's the date by which the contract expires. Someone was already typing that every option expires worthless. Yeah, if you hold it until it expires, and that's not the idea that you want to do as a trader, unless you're planning to exercise that option later. Where at expiration you have the authority, like you have the option to exercise if you really want, right before. And then you have premiums, which are the price of the contract, so what you pay for it. Um, Call option is obviously a bullish bet, and then a put option is a bearish bet. So, like I said before, any option you buy, you're pretty much uh, getting the right to buy or sell those shares at that fixed price by the expiration date. Um, you have three different types of options. You have in the money, at the money, out the money. In the money is usually below the stock's actual price, um, where if the equity price moved above or below your price strike, could affect your premium or your profit, I would say. A lot of big traders buy in the money because they tend to have higher delta, so it gives them more money or more profit on any move on the stock. At the money is usually people who don't know which direction it's going to go, so they try to be safe. And then out the money, if you see out the money puts or calls and they are going towards the flow, then that's usually either a bearish or bullish bet. And out the money is usually what most traders do, day traders do. And you just want to make sure that you take profit on those, because if you if they're really out the money, the Greeks will destroy the contract. So you want to make sure when you're going out the money, you're not going deep out the money unless you have a lot of time on them, which we'll discuss.
Yep.
Anything
Or
to that, Troy?
I was just gonna say like yeah, so like the more out of the money is just like you're paying less money for the contract, but it could like substantially have like better returns. Like I said, we'll kind of get into it with the Greeks, but like
Yeah, the
the out of the
yeah
money is
the
basically the farther out of the money it is, the cheaper it's going to be. But if the stock starts to move really quickly, that option is going to like double, triple, quadruple real quick.
correct.
It's exactly what happened on Friday when we had that huge move up. Like SPX
Mhm.
contracts went from 10 cents to what $42 or so. So
Correct, bio. That's how
yeah,
you get 100 to 40K.
uh-huh. So for
But that's
example, yeah, what's
yeah, that's high risk, high reward.
yeah, yeah.
What were you saying, Troy?
Yeah, that's just it. So basically what that means is somebody bought 100. If you bought those contracts at 10 cents a piece, what someone paid what $10. Someone
Mhm.
paid $10 because the option was 10 cents a piece, but you have to buy 100 of them. So it would have been $10 and then it went to 42 $2. So those cons went from 10 cents 100 of them to $42 for 100 of them. So
Right.
that's how they went up so fast, but yeah.
Yeah, yeah. But like that contract, that goes back, that goes, it's out the money, so obviously, yeah, the pay is gonna be higher, but it's shorter dated, so it's the IV that really moved that contract,
Mhm.
because the IV um was going with the market. As the market was pumping, it was causing a higher dollar value
Mhm.
change in SPIX, which was increasing the IV of the contract. So yeah, 100 to 40K out the money possible, but you also have to look at the IV and it's because it was zero DTE,
Mhm.
obviously. Yeah.
Yeah, it's not so exactly. It's just a lottery ticket. Like
Water ticket.
most
Perfect. Yep.
times ends the end of the day, like the options like for SPX, like $10 or $15 out of the money will be like $100. There'll be like $1 for per contract, but you have to buy 100, right? So I'll put like $100 lottery ticket on it, and sometimes if we get a big enough move, we have equal highs or something, and I'm like, okay, I think the 350 is going to take us there, and I've seen those $100 ones just go to $8 or $9, and then that's instant, seven, eight, $900 right there. But so
I
those
mean,
they're just
yeah,
lottery tickets.
yesterday was 80-point move, that reversal. That's very rare. I mean,
Yeah.
that's once in a while scenario. If you really want to play like lottos like that and you have extra money that you can throw away, you would want to wait for the end of the month. It's always at the end of the month on Fridays that stuff like this happens because they have to rebalance. So it's usually when you can just buy like a couple of like last hour you can buy a couple of puts and you can buy a couple of calls if you want, and then just ride both and see what happens.
Yep.
Um, but yeah, it's a complete auto, and you don't see those 80-point moves unless it's something special like the end of the day. The Friday yesterday I know there was a lot of ICT involved, but there was a huge gamma gex at for 5200, and the theory is there was a lot of big boys stuck in puts that they were trying to close at the end of the month, so they kind of push down the market to close because they know that there's no buyers until 5200, and that's what you saw massive buyers at 5200,
Yep.
and you saw a lot of puts being closed at that level, so that's what caused the spike. No one expected an 80-point move though.
For sure. All right. So these are your Greeks. This is how like your options really like move. Basically you've got, like what Dev was just saying, you have your delta, your beta, your gamma, your theta. Uh I would argue that the big ones are your delta, your gamma, and your theta. Um I'm not too well versed in the Vega and the Rho and the beta, just because Dev, you might be able to speak on those more. But basically, the higher your delta, uh, the higher your delta means. So basically, delta is. I mean, can I go back a slide? Let's see. How do I go back a slide?
What's up?
I was gonna go back a
uh
slide. Okay,
yeah,
so I'll show you
show
here.
them. Yeah.
So if you look on, let's look at the calls on the right side for Nvidia. If you look in the at the bottom, so on the right side down there where it shows delta, you'll see 0.09. So that means for every dollar that the stock goes up. So say Nvidia goes up $1, it goes from 1300 to 1300 to 1301. The delta, the premium of that option, say it's $5, it's going to go up 9 cents, 9.3 cents. So that's what basically your delta is. It's basically saying for every dollar that this stock goes up, that's how much the premium is going to go up. But then you have to factor in the rest of the Greeks, because then if you go to theta, theta is going to be, so every day that you hold that, the theta is going to drop the premium of that option that much every single morning just for holding it overnight, essentially. So like basically, if Nvidia opens up around so let's say this option's at 1300. Let's say Nvidia's at 1300, and this contract's at like $5. If Nvidia opens up flat for the most part, that one's going to automatically be down 56 cents, and that's just for holding it. And basically, the more out of the money that contract is, the higher your theta is going to be. um, and then as these contracts go up, the delta moves up. Um, I'm gonna hold a class later. It'll be a little more advanced, but it's basically going to be on call and put spreads. It's like I said, a little more advanced, but uh, uh, gamma is essentially uh, so for every dollar Nvidia goes up, the gamma is how much your delta is going to increase by. So the gamma is what, 0.0012. So for every dollar Nvidia goes up, the gamma, your delta is going to increase by 0.0012. So that's why I just think, like, I would say those are like the three big ones to watch. Dev, do you want to speak on Vega and Rho?
Yeah, so I mean, like, I like gamma. I don't really pay attention to gamma that much,
I
but
don't either.
yeah,
Correct.
you just said you do.
I I I I do,
Okay.
but
Yeah,
anyway, go
like
ahead.
gamma is just how the underlying volatility will change the delta.
Yep.
So yeah, I mean, I don't pay attention to it because I don't buy based on gamma. But I really think delta is very important. I think theta is very important, and I like vega. The slide that we had all of them listed, the Pac-Man was actually supposed to be on theta. I don't know how I got into vega. So I was probably playing around with it because theta eats away at your premium. So um, that's something you got to make sure you know. Any same day expiration 0 DT will have massive negative theta for sure, especially Spix calls. That's where you got to make sure you buy them at the end of the day if you're going to play them. Um,
Yeah, yeah, because that theta
but
would have sit
unless
there
you
all
know
day.
exactly, yeah, unless you know exactly where it's going and you buy it early in the day. But yeah,
Yep.
yeah. So like Troy was saying, like delta is just the impact the price on the option value. Beta we don't really care about. Gamma is the sensitivity of the options. Delta, which is what you want to look for. Theta is just the sensitivity. How sensitive is that option to the time? And then vega is how sensitive is that option to implied volatility. So the higher the implied volatility, the higher the vega, the more the premium's going to move up or jack up. And then rho is sensitivity to interest rates. I don't really care about that. So,
Yep.
um, yeah,
Yep.
and we'll go through each one.
Yep. Oh, you got all these. Okay. Okay. Well, I guess
Yeah.
never mind.
Well,
All
I
right.
did it just in case if someone wants to read through it later.
Yeah, that's true. Yeah.
Yes, Vega could mess up. Yes, IV crush. Correct, Plyo.
Yep.
That's how you get IV crushed.
Yeah, like Vega gets destroyed if especially on like an earnings play and it goes
Exactly.
say it it goes up high first and then it dumps and then maybe it goes back up. That's just crushing
Mhm.
the Vega and that option is going to be crushed no matter if it no matter how much it opens up or down
And that
even in your
usually
favor.
is when you're really out the money or out the money calls, that's usually what gets destroyed. So a lot of times you'll see on the flow whales buy like in the money calls because if the delta is higher, they can cut their loss down and make sure they don't get IV crushed if they're closer in the money.
Yeah.
But yeah, I mean, if you're gonna play an earnings play and you're a trader and you're lottoing, you might as well just use out the money. There's no point in putting such a high premium for in the money.
Mhm. Yep.
All right, so yeah, delta very important for options. Determines how much we get paid for every movement of the price. So pretty much, for every like Troy was saying, options value changes for every dollar move up or down in the stock. So the values for delta range from -1 to +1. Obviously, -1 or the more negative you are, it's on the put side. That's what you'll see on the puts for delta. And then on the calls, obviously it should be positive delta. The higher the delta, the more you're going to get paid. But the delta usually gets to be higher um, based on gamma, like Troy was saying, or also the fact that you're closer in the money or in the money. Um, and then gamma affects the change in delta. So the higher the gamma, the higher the delta. Um, so you can see if XYZ stock is up $1 and your XYZ call with a delta of zero point 0.3, then your contract premium moves up 30 cents. And then you see if it's a delta of zero point 0.6, your contract premium moves up 60 cents for every dollar. So like Troy was saying, if Nvidia goes up $1 and that premium what was that delta 0.09 or something,
Yeah,
Troy?
yeah.
Yeah. Yeah, then your contract goes up 9 cents
Yep.
for every dollar. Nvidia usually doesn't move up $1. It usually moves in bunches of dollars. So that's why your contract's going to fluctuate pretty
Yep.
quickly.
Mhm.
All right.
Alright.
Anything to add on this one? Oh,
Uh,
okay.
no, yeah, I mean, that's it. Just your
Okay.
your delta's gonna be higher the closer to the money you are, and the further out your expiration is, just because
Yeah.
it's a less risky, so but those tend to cost more those not okay, not tend. Those contracts will cost more than a further out of the money will. But yeah, gamma, yeah,
Yeah.
you could look at gamma as like this a small multiplier, yeah.
Multiplier. Yep. Correct.
Yep.
Yep. And then you have theta, so which is I usually just say time is as of the essence, obviously. So theta is just like time eats away at your contract. So options lose value over time. So if you have higher theta, the faster your options decay. So usually the higher theta is going to be when you're playing zero DTs. That's why you don't want to play zero DTs on choppy days when you don't have directions, or you don't want to hold zero DTs all day because theta is just going to eat away at your premium. So even if let's say you buy SPY 5:30 calls on Monday, and SPY is just chopping around, and it's like you bought them at 9 o'clock. Um, sorry, you bought them at 10 o'clock because 9 o'clock they're not open.
You're used to Central
Um,
Time.
yeah, I know. And you hold it until 2 o'clock. Um, if SPY gets to 5:30 by 2 o'clock, you're not gonna make a lot. That option premium is gonna be bunched away. You might still make a little bit, but you might most likely lose or close out on flat.
Yep.
Um, so short-term contracts have higher theta, so a lot of times you like to buy with time. I usually go, if I'm not day trading it and if I'm swinging it, I usually like to buy at least 2 weeks because data starts to really eat away after within that 2 week window, or sometimes 3 weeks out. Um, so negative theta is when time is not favorable, but risk is limited to make a higher reward.
Yep.
So just know that. Most long-term option holders will experience negative theta. Positive theta is usually for option sellers. So just know time is against you if you're day trading. Time is not against you if you're an option seller. So if
Yep.
you're a writer, theta actually helps you.
Yep. Because as that thing decays, the person that sold it to you is starting to collect that
Yeah,
premium, and
exactly. And
not
you're
you.
losing the
Because
premium.
someone's got to
Yeah,
make money, someone has to lose money. So
exactly. So
yeah.
theta is your friend if you're an option writer. Theta is not your friend if you are an option trader or day
Yep.
trader.
Hmm.
Yeah. So that chart just kind of shows you when you're near the money options, theta is lower. Like I said, out the money, where you make the most money, is always got some downside. So if you're going to buy out the money, buy with time. Don't buy short-term expirations
Yep.
because theta is going to kill it.
Yep.
Is the Vega. So increase or decrease in option premium due to 1% change in implied volatility. So the implied volatility, or the IV on the contract, is very important when you look at option flows, because the higher the implied volatility or the IV contract means that there's more buyers, and that's um, driving up the premium. So Vega will be higher in those cases. Um, so it's pretty much the market's forecast of the predicted movement of the underlying stock, what's going to happen in 5 days, 15 days, 30 days till expiration. The more out of the money you are, you can see the Vega kind of moves downwards. The IV volatility goes down. Um, so that's why you want to make sure that if you're following a flow, the IV volatility needs to keep going up on buys. That means that someone else is holding, like a whale is holding, so you feel more comfortable holding those contracts. Um, yeah. So it's affected by the contract expiration and strike. Longer dates options have higher Vega, and Vega and volatility are not the same. Yeah.
Yep. Yep.
Vega is pretty much how the change in volatility affects the premium.
Yep.
Volatility is just volatility.
Mm. All right. Well, let's see.
All right. So this was the example that you guys were talking. That is kind of confusing. I agree, Plio.
Yep.
Um, um, when you look at options flow and how to read them, though, you won't need to you won't need to figure out Vega.
Yep.
So don't worry about it.
Hmm.
Um, so this is the play that I think, Troy, you were talking about. This is the Friday play.
It's a good example of one. Yeah.
Yeah, yeah. So if you bought this, it was at 3:30. If you bought it at 8 o'clock, $8.50, it went up all the way to $54 almost.
Yep.
Um, yeah. So the implied volatility change, volume is low. Theta, you can see that theta is negative 1.17 because of zero DT. So
Yep.
that theta is definitely against you. So that price really got moved by volatility, because delta is not really that big.
Hmm. Um, I'm curious. I was curious what the I guess data would have came
I
into it,
couldn't.
but
Yeah,
just
I didn't.
to do the math, but
There's no way for me. I tried to find like what it was before and after, but
hmm
there was no way for me to pull it up. I would really wanted to show like a before and after comparison to see like
Mm-hmm.
how it changed.
Yeah, I'm curious what the price. I mean, I guess we could always look back on the chart and see what price was at 330 on SPX and then what it
Sure.
moved to there. But that just shows the power of this wasn't even a zero DTE, was it? Yeah, so is this a Monday contract? So
Yeah, because I can't look at any zero DTs after they're
oh,
closed.
because they're already closed. Yeah, I got you. Yeah,
Yeah.
yeah. You see, like if you bought this contract for 850 at 330, you could have then if you sold at the very top,
Yeah.
very
Exactly.
unlikely. But the contract went from $850 to 5 grand. So
Yeah, and it actually could have been even higher because you still have that 15-minute post close, and we went higher
yeah,
for like 5 minutes afterwards, even higher. So
hmm
yeah,
yeah. But, so anything you
yeah.
want to
So
talk
the
about here? You just showing okay. No, the 5240. Okay, so the 5240 is your strike. So
your strike,
basically,
right?
you were when you buy this contract, you're betting that SPX will be $5,240 by close of business on June 3rd, 2024. That's just your strike price.
You're pretty much making a bet that when you bought the contract, it was not at 52.40. You're buying it saying like, I'm betting that I'm gonna buy this at $8.50, and by June 3rd, Spix is gonna close or is gonna be above 52.40 for me to make money.
Yep.
And it went, yeah, above 52.40. Yeah.
Well, 50, not like 5240, and it's kind of it's okay. So the 5240 and the strike price just happened to line up here to where they're both like worth like
Oh yeah.
five grand. So like you're
You
betting
can
that
pull up a chart and show 'em.
yeah, you're betting that SPX will be at 52,240. The the 5380 is just it just how happens to be that's 5 grand as well. So it just so happened to work out that way. But yeah, you're betting the SPX will be 5240.
Yeah.
Uh,
Yeah. Yeah. So these are just some examples of just contracts. So you can see here, Delta. Um, I mean, based on this, which do you think you would buy, Troy?
uh
Which one would you buy more of or more likely of?
I hate
Just
trading
looking
spy.
at the
I hate trading spies, so
I know, but just looking
no.
at group,
uh
I personally
I'm
would
going with the
buy the
spy.
SPY.
Yeah, the spy.
I would buy the SPY because if you look at it, the same expiration, the SPY
Mhm.
has higher delta, higher gamma, higher theta,
Yep.
and has higher vega. So that
Yep.
just tells me that that contract is going to move much better. Q might move, but the SPY might pay better
Yep.
based on those deltas,
Mhm.
those
So,
Greeks. Sorry.
yep. And then for like swinging contracts, the way I've always done them is like especially for earnings, if you take your delta minus your theta, not including the gamma, it's just to get a ballpark though, like for earnings. So say okay, this is Q, so this isn't really say Q gaps up $3 overnight. So you would take your delta times three because it gapped up $3. So it would be $1.20. Your contract would be up minus your theta times three. So what, 18 times three, for example, would be like 54. So your delta would have your contract up like what, $1.30 minus 54. So what's that, like 80 cents total is what you can expect your every contract you have to be up. So if that makes sense, that might have been confusing. I'm not sure, but
Yeah, he's just telling you how to calculate
yeah,
in case you wanted to calculate what your profit's going to be. But the one thing that doesn't take into account is the IV
yeah,
crush. So
correct.
a lot of times, even like Robinhood would be like, oh, you took a Nvidia 1,000 call for earnings, and if it hits this price, you should have this much profit. But if you it never is 100% because it does not take into account IV
Hmm.
crush. So
Uh, Here, I'll type it
yeah,
out
maybe
file.
just type it out for
Yeah,
Plio. Yeah, might be easier.
yeah. basically delta is how much your contract should be up, and then your
Mhm.
theta is still going to get subtracted from that delta. So basically, I guess an easy way to say it, yeah, would be so if 43 minus 18. So what's that,
Yeah.
25? So 25 cents for every dollar Q is up in the morning is a rough idea of how much your premium should be up.
And that's exactly why like that SPY call is better than the Q because the delta is higher already and the theta is lower. So you're already gonna make more.
Yeah, so see, you're gonna make
Than
about 31 cents for every dollar spies up compared to 25 that the Q is.
Q is, yeah. Roughly without adding in the
Yeah.
other stuff
Yep.
to it that
Yep.
affects it, but yeah.
Yep. Let's
Yeah, so there's benefits and risk obviously. So the benefits is that you pay a lesser premium. You have less principal and lower transaction costs, but higher returns if you do it correctly. So like buying 100 shares of an equity at $40 would cost you 4,000, while paying an option might just only cost you 400. It's also an easy way of hedging a portfolio, especially if you're like a long-term investor. You can be a put seller to collect premium on your 100 shares, at least 100 shares. And if it goes against you, then you can sell those shares or close them, whatever, and you don't have to cover the loss with real money. So summary is there's upside gains, limited loss to premium paid, leverage to increase rewards, and risk hedging. Um, if you pay $4,000 for that stock can go down to $0 and you can lose 4,000, or you can pay 400 for that contract and that stock can go to $0 and you lose 400. So that's your risk versus reward.
forward.
Um, Risks, losses can be amplified depending on the strategy. We'll talk about it. Writing puts to collect premium can definitely go super against you if your stock soars. Um, well, what happened to Discord? Um, yeah, it's complex to manage. Obviously, you can't just set and forget it. You have to look at it, look at the charts because it's based on market volatility and market movement. So if the market somehow dumps one day or pumps one day, it can completely go against your position.
Yep.
And then tax consequences, like I said. So closing in profit counts as profit, so you can be taxed unless you exercise that option to buy the 100 shares or sell them. Then it doesn't go towards your capital gains
Yep.
because you're holding those positions.
Mhm. Yeah, I will say like this might seem like for anybody that's ever traded options, this might seem like a lot, but like I wouldn't say like every day if you're trading this, you're not thinking of like all of this stuff. Like you're not like sitting here like and like going back and forth of which one I should buy. Like when I'm trading them, I'm more looking at I'm like buying a week or 2 out, and I'm buying, towards the money, and then I'm looking to sell, probably the same day, or if I'm swinging some options. This is just breaking
Yeah,
down how and why these options move. So it may sound
yeah, because
complicated, but it's really just you're just looking
this is
to yeah. Go ahead.
yeah, this is options 101. So like
Mhm.
this is just for you to understand um what you're dealing with before you do it, because it's important to understand the underlying I guess how options really work before you play them,
Mhm.
so that you're not like confused on what really happened to your contract in case it goes against you,
Mhm.
or yeah,
Yeah, this is why a lot of
yeah,
people
no.
move to futures too, because there's no Greeks, right? These things don't futures. The thing about options is you can't just sell like, I want to sell when ES hits here. You have to just sell your contract when it hits there. You can't say sell when SPY hits this price, sell when Q hits
Right,
this price.
you can't sell. You have
Hmm.
to like what you can do is though you can use the Greeks to calculate what the premium could be at that time and set
Yeah.
um a sell like order for that premium.
Yeah.
But again, you'd need to know the Greeks to do that. But yeah, you can't just like go and be like, I want to sell this. No, you can do limit orders,
You
Pyro, but like you'd
you
have
have
to
to
guess what the premium's going to be
yeah,
unless you know what your premium
you have to put a limit order on the premium of the option, not like
is, right? Not the stock.
not the SPY stock price. So
correctly.
that's why a lot of people like go to futures because like they can hold ES or NQ all day, and you don't have to worry about the options going against you. But the risk reward, you can make a lot more in the options than than in futures. So I guess it depends on your risk management. Then we get into risk management and a whole other boatload of worms. But yeah, for platforms, I personally, yeah, Thinkorswim or Webull. I know a lot of people love Robinhood too. I personally hate Robinhood, but Dev, you use Robinhood, don't you?
Um, yeah, well, so my issue was that I have a long-term investment portfolio with TD, which got switched to Schwab, who I hate. And then I got switched from that to I was trading in my long port and it was kind of tilting on red days for me because I would see like my port dump like 10K and then I would be like, okay, well this is dumb. So it was kind of tilting. So now I've kind of split it up so I don't have to use Schwab for trading and use I use Robinhood for day trading. And then I just pull money out of Robinhood and just put it in Schwab when it profits.
Yeah.
But the only thing I don't like about Robinhood, two things. Um, they force close your zero DTs if you do play them by 3:30. So like if you were playing Robinhood on Friday, that massive move happened after 3:30. You missed out on that whole massive move if you played zero DTs because they force close them at 3:30. So
Hmm.
that's one downfall. The other downfall is there's no SPICs, so you can't play SPICs options.
Yep.
So if you really want to play and not have to be force closed at 3:30, you can do Think or Swim because Think or Swim is awesome for that. It's a part of Schwab, but it still has the original um, like breakdown, same as TDA. So you can still use that. Um, or you can do um, Webull. Fidelity also force closes at 3:30. I don't know why they do that, but it's just kind of dumb.
Yep.
Um, oh, Fidelity doesn't close SPICs at 3:30. Okay, that's great. I know they do allow
Hmm.
pre-market trading on SPICs, which is nice if
Yep.
you want to do that. Yeah.
Yep. I hope I cleared it up for you, Plio,
I
about
was
about the
sorry you were
premiums.
making a guess if you sell limit or buy limit. Buy limit, Shakta, buy limit could be based on where you think the price of the stock is going to. So let's say you think it's going to go to a support first and you want to buy at the support, the call option or the put option at the support or the resistance before the stock goes up. You can set the limit based on that. Um, I was thinking of there was a way you could do that. Sometimes I know Weevil does this. That chart, Troy, you want to go back to that example of the
Yep.
SPICs?
There, there.
Yeah. So Webull actually shows you if you click a contract of any option, right? And you can click on the contract. Webull shows you a minute to minute price movement of that contract price, just like what you see with like stock movement. So that's the graph of the contract price right there. There's a chart of the contract price. So if you want to like try to time limit sells or limit buys on contracts, you can possibly line up the actual chart of the stock and that Webull contract price and see where they line up to kind of estimate the limit if you don't want to calculate it.
Yep.
Do you know what I'm saying? I don't
Yep.
know if that makes sense.
No, no,
Yeah.
that makes sense. Yeah. Yep. It's more of something that you have to like babysit. I would say,
Exactly.
like
Yeah. Yep. Perfect.
you just don't want to walk
Unless you
away
know,
unless you plan on holding it and you're going to swing this for a couple days because like you're expecting buy side to hit like a weekly or a daily high to hit in a couple days. Then you're
unless you
fine.
buy like 5 contracts, let's say at $200, so you spend $1,000, and your goal is $500 for the day, then you can just set a price limit sell, um, for those contracts to close automatically or sell at per contract to get that $500 per day
Yep.
limit or your goal,
Yep.
like a 30% gain or something on a contract or 20% gain.
Yep.
That's your goal.
Yeah.
Yeah. Okay.
And then yeah, Marshall. So like, I would at least go if you're planning on selling the same day, but like, say you wake up and NQ's bullish going here, you could buy like maybe like 2 to 3 days out, so it doesn't kill the theta's not working so much against you. And then I mean, you could go up to a week out, I would say, but like, and then obviously the closer to the money you are, the less your theta is going to be. So it's not gonna decay as much. But then you can still sell it that same day.
I only take option calls that go a week out if I am certain where I know where the price is going. Because let's say you took call options on Friday for this next Friday on 6/7, and you're expecting, let's say you took SPY 5:30, you're expecting SPY to open up at 5:30 tomorrow. If it does not open up at 5:30 tomorrow, that contract's already going to be red because data's already going to eat away at your premium
Hmm.
because it's a weekly.
Yeah,
Okay.
yeah, because
Uh,
yeah,
you
that's a good
you
example.
skipped you
Oh,
skipped one.
there you go.
Go back one. Okay. Yeah. So these are just simple trading strategies. So just so you can see it. So you have a long call. Obviously, it's a directional bet. It's bullish. So the loss is limited to the premium paid, and the reward is unlimited. So you can see per chart here. Um, so if you pay $5 for that contract, your loss is limited to the $5, but your profit could be unlimited based on where the price of that stock goes. You can see that there's the strike price right there, and then right above the strike price is usually where you break even, where your strike equals your premium. Okay, so you can see here that these are examples of SPY calls that you see from the flow. So 621, 530. This guy actually bought this at the bottom yesterday. It's crazy. Um, yeah, he bought him for 5 million total, and he's already up 70 or 65% or something on Friday. Um, but yeah, so like he bought them at on 621, and he bought them I think at like 518 or 519, and SPY closed at 528. So he's already almost close to um his strike price. He's not even there yet. So he's still holding. So if it goes higher, he's going to go even higher. His profit's unlimited. He's already up 60%. So
Yeah, that's why I do like for SPX at 350 most days, especially if we expect some kind of movement, because we
yep.
know price is going to move at 350 to any remaining liquidity. So, and it's your chance to really make a contract, you know, double,
Yeah, if
triple
you
in value.
for example, you see that ES is lagging and NQ is moving, you can also trade NDX instead of um SPIX.
Yep.
NDX is a SPIX version of Nasdaq, but the premiums are super jacked.
Yep. Yep. Uh,
We already got Plio gambling. Okay. All
yeah.
right. So you have a long put. So again, directional bet. It's bearish now. Loss is limited to premium paid, but the significant reward is also limited. That's the thing about puts. The reward is limited, unlike calls. Calls you have unlimited profit, unlimited reward. But again, your loss is limited to what you pay for the premium. So you can see some SPY long-term puts that someone bought at 8 o'clock, at 9. That's Central Time, so don't, you know, that's right where we started dumping, by the way. That's when they bought those. I'm sure they already sold those.
Yeah.
Um, Nasdaq NDX is
I don't
trash.
know.
Yeah, unless you catch it, Angela. If you catch it right, I mean, I've turned $3 to 3,000 with NDX. You just got to catch it right when it's going towards you. Play. But yeah, I do agree though. Spix has more liquidity. You're right.
Yep. Let's see.
Next,
Next,
Troy.
oh, sorry.
I know you're falling asleep over there.
No, no, no. I was trying to find
Um.
your NDX that you sent me a while back.
Oh yeah, the one that closed up 1,000%, but then I never got the money
Yeah.
because it expired. That was
Yeah.
dumb. I didn't get to close it in time, so it expired at 0.
Yeah.
That's what at least TDA told me. Um. All right, so we have a bull call spread, so bullish outlook. You'll see a lot of this on the flow. I'm just showing you guys this because this is like what you'll see on the flows. So they're buying a call option and selling a call option. And they do this because they want to limit their risk, but they're still bullish. So like they know like a stock is going to go to a certain number, a certain price, but they know it's not going to go as high as another price. So what they do is they buy a call with a strike price where they think it's going to go, and then they sell a higher strike price call to collect premium on where they think it's not going to go. So that way, any difference, any loss that they have is paid by the call selling, and then if the stock gets, they pretty much make money both ways. Essentially, that's what's going on.
Yeah.
So you can see here at Snow, this was on Friday. Some multi-leg. Someone bought a ton of November 145 snow calls, but then they also wrote November 195 snow calls. So they're pretty much collecting premium on the 195, and they are hoping to get profit on the 145s. So pretty much they're saying that by November, snow is going to be between 195, lower than 195, but above 145, and that's where the profit is.
Hmm. Yeah. Like I said, that's a little more advanced, but like
Yeah.
when it comes to like spreads and some people will have puts and calls too. And then like as long as the price closes in the middle of there, but uh, this is all like, but yeah, I mean, this is all options does that sometimes. Yeah, yeah, he does. But like just for
Oh,
basics, yeah, just remember just simple calls and puts. But this is just a little more advanced stuff. So uh, look at that V. Dev, did I lose you? I think so.
no,
Oh,
sorry, I'm
okay,
here. I just
okay.
had someone calling me. Yeah, so yeah, this is the put spread. So it's the same thing. You're just buying an option and selling a put option.
Yep,
Obviously, the one that they're selling is going to be lower than the one you're buying because you expect the price to go low, but you don't expect to go so low. Then you have straddle. Um, so straddle is where people are pretty much unsure of the direction. So you'll see them buy both calls and yeah, both calls and puts, but with the same strike price and expiration date. Both are at the money and both have upside or downside risk are limited. It's pretty much they don't expect the price to go anywhere.
yep.
And then a straggle. This is what I usually do for most earnings. If I'm going to play it, I do a straggle. So it's a similar thing as a straddle, but you buy out the money and you have different strike prices but same expiration. So like if I expected, I don't know, if I expected Lulu to come into earnings and I want to play it, maybe I buy a $350 call for 614, but then I also buy a $250 put for 614. So that would be a straddle. And then you have hedge puts where people just buy puts to hedge their long portfolio.
Yep. Yeah, like
I mean, Troy will probably go through more of the spread stuff. I just wanted to introduce it a little
hmm.
bit.
No, yeah. So what he's saying is like anybody in their long ports, if they think like the market's gonna come down to like a downturn for a little bit, they'll just buy like longer dated puts. So those puts make money as their like long shares lose money, but then they don't have to share they don't have to sell those long shares if that makes sense. So there is
Yeah,
hedging,
offsetting the
it's just
loss.
hedging.
Yeah.
Yep.
Yeah.
Uh,
Okay.
let's see, a couple more slides here.
All right, options flow. So you only got like 3 more slides and then we're done.
Yep.
So, um, so this is what you need to look for options flow. I mean, I post options flow when I can. So there's main points to look at. You want to look at the strike and the expiration should be the same when you're looking at a options flow. You look at sweeps versus blocks. Okay. I usually do not look at block trades. I don't like block trades because block trades are not they're not giving you any direction. Okay, they're predetermined trades. Um, and then you look at contract price changes. Okay, if they are holding a option or keep buying it, the contract premium keeps increasing. So if you see on the flow that the contract premium is increasing and the IV of that contract or the volatility of that contract keeps increasing, that would indicate that they are buying those. And that's how you know you can follow a whale. Um, so block trades are usually negotiated and tied to other trades. So usually that's why I don't follow them because they're predetermined between entities and they have prices set already to discuss. Sweeps are usually larger trades that are put in across multiple exchanges and they're usually urgent trades. They're done at market orders. So those are usually the ones you want to follow because those are like, oh, I want to get in right now because I know this is going to happen. Um, so I put examples on those two,
Yep.
both of those on there. Um, And then we have three different terminologies for any options that you'll see. You'll see above ask, which is AA. You'll see at ask, which is A. You'll see bid, which I forgot to put on there, which is just B. And then below bid. Bid and below bid are usually being closed, or there are options being written. Above ask and ask are usually being bought or opened.
It's basically following big money with this flow. This is what big money's currently buying. So,
I can like feel big money in quotes when you say that.
yeah. Yeah,
Okay.
it's like, I mean, it's just like following like Bookmap or footprints for futures. You can see
Yeah.
where money's being placed. So
Yeah.
it doesn't take
Okay.
the place of technical analysis, but it definitely is a
Right.
nice confirmation that if you think you're
It's
bullish and then that they're
look at
buying that
charts.
too.
Look at charts first, and then look at contracts for that for the equity,
Yep.
and then you'll know. That's
Yep.
usually what I do.
Yep.
All right, next. So you have bearish calls. So if you're using black box stocks, um, that's usually what I use. You look for yellow calls that show up bid or below bid. That means that these calls are being sold to open. These are option writers. So you do not want to follow these unless you're going to be writing options. And it actually goes it actually goes against like sorry, I'm saying like so like this person right here wrote TQQQ calls on 531. They wrote him for 628. You can see here that the IV actually dropped while the premium went down. You guys see that? So like the premium went down from 3.2 to 2.36. So that premium drop, that means they're writing those calls. And then the IV went from 47 to 46. So their IV is also dropping. So these calls are being written and being sold by whales. They expect TQQQ to be below 62.5 going into 628. Now that doesn't mean that they hold these calls. They don't close these before 628. This is just something that they wrote on Thursday. They could have already closed this on Friday. I didn't look at that, but um, because Friday we did dump, and they probably need a big amount of money with writing those calls when they close them. And then you have the bullish puts. Um, so these are you can see Nvidia on 531 for 7.5. These whales wrote 10 20 puts. So they pretty much sold these puts to open to collect premium on them. Nvidia did not hit 1020 yet, and I don't think it's going to. So as
Hmm.
long as the price keeps going higher, these whales are going to keep making money by collecting premium on those puts that they wrote.
Yeah,
So
essentially, since it's not in the money and it's still out of the money, they are banking on it not being below 1020. So anybody that's buying like those 1020 puts and the money that they're losing from that delta from that theta is going in these guys' pockets instead. So
yeah, okay. And one more.
one more.
All right. So these are pretty much examples that I just wanted to show you guys on what I look for. Um, So you can see here on the left side, we have NVIDIA calls that are opened on 531. Anything you can see on the yellow box, they're all at ask or above ask. These are all being bought to open by whales. The premium price is going up. So the premium price went up from 30 all the way to 37. So these are all being opened, they're all being bought. And then you can see that the IV went from 50 to 52 or 53 and then 52. So IV is going up while premium's going up, and they're all at ask or above ask. This is the type of flow that I would follow because that would tell me that this is a whale that bought and they're holding. You can see the one from 531 for 719, 1200, same thing. IV is going up. It went from 45 to 46, but the premium is jacking up too. It went from 32 to 45, and they're still holding. They're still opening. So they're really all these are buys, and this is the type of flow that I would follow based on the chart as well. And then you can see we have a more confusing flow on the right. On 531, they bought 719 buy calls for 540. but you can see that the IV is dropping on the buys, and then the premium also. Sorry, the IV went up, but the premium dropped. It went from 2.45 to 2.09. Okay, that's a mixed flow for me. I would not follow that because I don't know, because the IV went up but the premium dropped. So
Oh,
that's confusing to me. So I don't really follow that. It's not clear. You could follow it. It's a 50-50. It's a 50-50 trade there. It could go either way if you're following that flow.
yep.
And then you have these Q calls, which I would follow, um, just basing looking at the chart. These were all opened 531 for 621. The IV is stable, but the premiums are kind of moving up. So again, this is another 50-50 one. But I just want to show you guys some different types of flows that you usually normally see, and how to differentiate between, like, what's clear versus what's kind of confusing. But again, like, flow is something to help you with your chart, not something to just go like 100% on.
Yep.
Troy,
Yeah, no, that's exactly it. Yeah, no, I was just agreeing with you. Yeah, like
you
I
playing
always
Rocket League?
no what no, I always make fun of Flow.
I know you do.
I always give Dev some crap for just for using Flow, just because it doesn't take the place, of technical analyst, but analysis, I should say. But like if you see a whale back in your position and you think we're going up to a daily high or something, then I mean this is what I mean. Then it's just a it's just extra confirmation to
Yeah.
yep.
But I'll post some other stuff for you to post some other
Yeah,
stuff in my thing that you guys can read up on.
that's funny.
See, Amy's like, it made more sense.
Just think of the
Yeah.
options flow as you're just looking at what the whales are doing. So,
It's
but
a confirmation of your bias.
yep, yep. It's just important to read so if they're buying or selling, basically.
Bio, if that said B or BB, bid or below bid, then I would think that that contract is either being sold or being sold to open, versus ask or at ask, which would mean that they're buying those contracts, they're
Yep,
opening them.
yep,
So if you're bullish on Nvidia and you see those calls show up on the left side, then means that you're on the right track and you could probably be bullish with these guys. You feel a little bit more safer, or you feel like, I guess, more I
yeah,
guess, solidified on your bias.
yeah.
And you can
A or
even join
AA.
them if you want.
Yep,
Yeah.
yeah. A or AA usually means they are opening that position because they
Yeah.
expect it to
It
go
it
that
goes
way.
the it goes the same thing with puts. So if this was Nvidia puts on the left and the IV was going up and it was at ask or above ask, then they're being bearish on it.
Yep.
Um, any relation to open interest? Yeah, so these contracts, um, Angela, these contracts should get rolled into the open interest for 1100 calls, 6-7. But for that day, they would show up on volume, not open interest. So what you would see is on volume, let's say they opened 100 of these, 1,000 of these contracts, then the volume should be 1,000, at least 1,000 or higher, because someone else might follow those contracts. And then the OI should be the same for that day. But the next day, those 1,000 should roll over if they're holding into the OI, if that makes sense.
Yep.
Um, so you try to follow people who are big money. Yes, correct, Plio. That's the idea.
Yep.
But never follow blindly. Always look at the chart first.
Yep.
And you can still use your FVGs on your chart too to
Oh yeah.
determine the
Yep.
directions. Yeah. Um, cheapest service for flow. Cheapest service, I think, is depends on what you really want, Ace Man, but um, Unusual Whales is pretty cheap. I like Black Box. They're a little bit on the expensive side, but I like it because they provide a lot of dark pool readings too, and I like to use dark pools. We can do, a session on that later, but
Oh, you're getting into a whole another can of worms now.
yeah, but a lot of times these people follow. A lot of people follow flows with dark pools as well, because you'll see a lot of dark pool prints show up, and then you'll see, followed by dark pool prints, you'll see flows show up, and that support the dark pools. So that's another way to look at it too. But yeah, the cheapest service is Unusual Whales. There's other options. There's TradeEdX. There's also
There's
Blackbox Stock.
Cheddarflow on Twitter, right?
Cheddarflow, yeah, Cheddarflow is expensive, but yeah, Cheddarflow. I use Blackbox Stocks, but that's just me. I used to use Unusual Whales too, but sometimes there's too many things that they offer, and it kind of I don't know. I like simple things, and I think Blackbox Stocks is pretty simple.
Cool.
Um, yeah.
Cool. Uh, all that. Is there any questions on anything? I think you guys did a good job of asking along the way, though. So, but
Yeah, well, if
yeah,
I'm trading this week, I'll post some flows that I see.
yeah,
But as just the sources, but
yeah. Cool.
I'll post some flows that I see in my alerts. Doesn't mean I'm actually following them all the time, but I just post it for you guys, um, so you can see.
Yeah,
I work, so it's kind of hard for me to follow all the times unless I know the chart.
sure. Yeah.
Yes.
Yeah, that's a good idea, Plow. There's some
Good.
really good
Yeah,
videos on just on
yeah,
basics.
definitely. I want to see if hold on, let me see if this is accessible to everyone. Black Box Stocks has a no, like they have their own flow classes. I don't know if it's open to public, but yeah, Black Box Stocks is expensive.
What's
Oh,
expensive
PDT, it's like $99
for per month?
for a month. Yeah,
Holy cow!
but I make way more than that, so I'm okay with it.
Yeah, right.
Um, yeah, I think Whale is like 40,
hmm
and TradeEdX is like 69 or 65, something like that. But TradeEdX has a lot of other stuff too that you can look at. You can look at market structure. A lot of a lot of people have been liking Market Tide on Whale. It's like a new feature that people play, especially if you play like fixed calls, because the tide tells you where the market is going, if it's going with calls or puts. Um, and then you can ride one side until it switches over, and then you just switch to calls. It has like a pretty good win rate, from what I've heard.
Interesting.
If you want to do that, yeah. PDT
Yeah,
rules.
I'll go over that quick. Yeah.
Yeah, you want to do that, Troy?
Sure. So basically, like when like this the options and everything sounds it sounds great and all, but it does come with a pattern day trading rule. So essentially, you cannot buy an option and sell an option in the same day, three times over the course of what is it, 3 days, Dev, or is it five? It's 5 days, isn't it?
For
For
PDT, you said
PDT, yeah.
PDT.
Yeah, it's 5. Okay,
Yeah,
yeah.
I think
I
it's
thought so.
yeah, I
Yeah.
think it's
So
5.
basically it just so it's that's only for accounts
Big money. That's why.
that yeah, that's for accounts that are margin options accounts, and you can only trade yeah, you can open and close, three times within a span of 5 days. Unless you have $25,000 in that options account, and then you can trade unlimited. Or you can open just a regular cash account.
Yeah, just open a cash account,
I
guys.
would recommend a cash account, because so basically, if you open a cash account, say with $1,000, if you buy like two options for a total of $400, you can't use that $400 until you sell it, and then that money needs to settle overnight, and then you can use it again the next day. So it's kind of like setting a limit for yourself. That's why I recommend it, so you can't overtrade. Um,
Yeah.
so it
Yeah,
just
it's good. Cash accounts are good. That's what I do on
yep
trading. Essentially what you can do is, like Troy said, you start with $1,000. If you're day trading, you use up the money, you get your profits, you get out, settles the next day. It's T
yep
plus one.
yep
If you're swinging, then you have to wait, sell it on that day, wait the day after, and then you can trade.
yep. Yeah. If I was starting an options account, I mean, you could start anywhere from I don't know, 500 to $1,000, and just buy,
Yeah,
just look at spy calls or Q calls that are close. You can start just by trading one option just until you get the hang of it. Um,
correct. You don't have to like go big money right away.
yeah.
Like
Mm-hmm.
trade one or two options, try to get a hang of it.
Mm-hmm. I like to start like with a five or $1,000 account, and then just be patient and try to build it up to 10K. But
How did I start with 3? I meant 300, buddy.
300.
I mean, like a $3 contract, that's $300. My bad.
$300. Yeah, yeah, yeah. But yeah, I would recommend going with a cash account first, so that way there is no pattern day trading rule for cash accounts. But if that all
Yeah, the only
makes
reason I
sense.
used to trade in my long account is because I had margin on it. But yeah,
Yeah.
I'm good.
Yep. Uh. Yep. Exactly. Yeah. Because you gotta multiply it by 1,000 or by 100 because you're technically the option is so like whenever you see like a premium it's a dollar, it's actually $100 because you have to buy 100 of them because it's 100 it's equivalent to what we were showing like it's equivalent to 100 shares.
Are you talking about, was that $10 for the Spix play?
Well, so the Spix play was 10 cents, so 10 cents times 100 was $10.
Oh, gotcha.
So 10
Yeah,
bucks turned into it. Yep.
that still beats buying 100 shares of SPX
Yep.
though,
Yep.
because you're paying 1,000 for 10. You're
Mhm.
paying $1,000 for to play what, 1,000 shares
Shares. Yeah.
of SPX versus buying 1,000
Mhm.
shares of SPX. So your risk is limited, but your reward is higher.
Yep. Yeah, had my I wish I could see like the what my deltas and stuff were on the Apple on my Apple earnings play from a couple weeks ago, but
You can look at the oh yeah,
cuz I could go over that and kind of
that
like show
sucks.
it,
Yeah, I
but
know, like how the how the earnings play got moved up. Yeah,
moved up. Yep.
I wish there was a way where you can go back in time and look at those contracts. Yeah,
Yeah, it would be nice.
yeah, but I think you bought them. What did you buy them at?
I bought
Like
them for like $1.60. Uh,
$1.60, and you sold them at what, $8?
$8, yeah, something like that.
Yeah, overnight move on earnings.
Mhm.
Ivy got pumped.
Let me see if I don't
Yeah,
know
Troy
if
turned like, what was it, Troy? Like 2 grand or three
mhm.
grand to what? Like 16?
16, 17, yeah.
Yeah, overnight.
Um, yeah. So another thing I'll go over real quick. The way I like to trade options or swing options in the ICT world is using a 4 hour or a daily inverse. It's pretty much what I did with here I'll show. I had the SMCI play a couple weeks ago, and you see, I just look good. So I bought like it was like a week or two out SMCI calls, and I seen this LRLR with the 4 hour inverse, and then I just look for higher time frame inverses or or order blocks, and then I'll be looking at like a week or two out calls that are kind of near the money. These ones were a little farther away from the money because I didn't want to spend 2 or 3 grand per contract, but yeah, so I just look for higher time frame inverses really, and then obviously the LRR helped it. So
hmm
that took those contracts. I think I bought them at $3 and they hit 10 like 10.50. So so the $3. I think I had six of them total. So 350 to $3 to like 10.50 was like $700 for times the six contracts.
I
So
was in that SMCI call before Troy, by the way.
yep, yep. So I three times my money, but I did trim on the way up, so I didn't hold all of them until $10, but still.
I did call that SMCI call. I don't know if anyone possibly followed it, but I did post it on my alert. It was like $1 and it went up to like 1,800 or something.
Hmm.
I know I did, but
Yeah, but yeah. So I just look for in for inverses. I'm just yeah. That's that's it. Or I'll buy like options. Like usually, I'll buy them a lot of times. If we see equal highs, equal lows, and I'll buy like like a couple days out. Um, but yeah, that's how you use them in the ICT world. So or a trend day, I'll just buy calls and or puts and just ride. But yep. Anything else?
yeah, Angela. So if you have a 25K, you can buy and sell many times, but with less than 25K, you close a position more than 3 times. Yeah, they don't really freeze it. You can actually switch. You can request it to be switched to a cash account to overcome the PDT, so you can trade again, or you can request a once per life reset on that account.
Hmm.
Just so you know.
Yep. Plow, I would say $50,000. No, no, I'm just kidding. I would say anything. I would say like 500 to 1,000 is probably a good start.
Yeah, if you're
It's
new, just start with a
yep,
thousand.
yep,
Don't play zero DTEs.
yeah. Just don't play zero DTEs by at least a couple days out at minimum. Um,
Yeah, and if you want to play Troy's zero DT Spix, then make sure you get you do it Weeble, Fidelity, or Think or Swim,
because yeah, you can't
because
trade the
Robinhood does
options.
not.
Yep,
Yeah.
but I love Weeble's interface and the way their whole thing is set up. So that's my recommendation. But Thinkorswim's good too. What are you
Yeah.
laughing at, Dev?
Amy said, "Good stuff. Time
Oh,
to deposit in Weeble again."
oh, yeah, yeah. Like I said, if you guys have any questions, our DMs are open at any time. Or there's obviously plenty more option stuff on YouTube as well. But it's just a
Hmm,
good
hmm.
a good introduction. That's just how they move, and how people can be like so profitable from them. But again, they're higher risk, so higher what comes with higher risk comes with a higher reward as well. So
Yeah, and if you're paid member, I'll put this up on my alerts channel. The what do you call it? The PowerPoint, and then I'll
okay,
also put up a couple of links you guys can look at.
perfect. Perfect, perfect. I'll put the recording
Mhm.
in the free classes channel and pin it as well, so anybody can go back and watch it. Cool. Well, if there's no other questions, yeah, we can do a live session. Like,
Yeah, we could do that, Angela.
yep, yep, absolutely. Mark's class is going to be next week. Now, he thought that having two classes a weekend was a little much, but anybody that is still premium from when we started the Discord will still have access to that class. So since we're not coming up on the 13th yet, so yeah,
Good. I teach you
it'll
guys options. You teach me futures.
yeah,
I'll
yeah,
be there.
yeah. Dev's still learning futures, so yeah, we're switching it up here. So all right, guys. Well, if there's no
All right.
other
Sounds good.
questions,
Have a good weekend.
I will knock it out here. Weekend. It's already Sunday, Dev.